So in the week just gone, I had a stock that crashed a huge amount. It was down nearly 45%, and I even had some of you guys ask me on Instagram and even on the YouTube comments, what are my updated thoughts on this stock? So today I'm going to give you my updated thoughts on this stock that crashed massive last week. So I hope you enjoyed the video. Let's get started. So the stock that crashed quite heavily last week was Yougov, which is quite a relatively new position into the portfolio. I only started buying Yougov around about 7 months ago, and even when I made that video about 7 months ago, what I said on that video is I would like to get the stock a little bit cheaper before I carry on adding into the position. Now, what I did not expect to see is a 45% drop in the stock. I was thinking more 10-20% drop, but this is a big drop off a profit warning. So with a big drop in the profit warning, I had to reevaluate the position and go, okay, do I sell? Do I carry on buying? What's my game plan now after this profit warning? And today I'll kind of give you that updated thoughts on Yougov stock. Now it is now a 524 million market cap, trades at around 22 times earnings, so about the market average at the moment, and it does pay around about a 2% dividend yield, so you do get a nice bit of a dividend from this stock. But overall, the stock has now been devastated really since 2022, and now the stock is actually down from that time frame around 67%. Now that drop in Yougov stock actually now puts it to the levels it was at around about April 2019, which is a very serious pullback, especially when you look at the company's financials. You know, you start looking at the company's financials from about 2019, and the company has gone from 126 million in revenue up to 270 million in revenue, and you look at the profit has gone from 11 million up to 28 million. So the company has massively progressed from that time frame. However, now the share price is back at those sort of levels. Now Yougov, I'm sure most of you guys have used it or heard of it. It's a site that is able to give you a lot of data. We know companies at the moment like the access to data to try and help them improve their target audience. So you might be looking at someone like a celebrity, for example, and you might be thinking, okay, would it be a good idea to get that celebrity to endorse our product? Are they a popular celebrity or are they not a popular celebrity? And this is what a lot of companies do. They go to Yougov, or individuals go to Yougov and go, okay, I want to start a project, I want to launch an advertising, I want to make sure I've got the right data, and also how's our company doing? Is our company targeting the right places? And Yougov is that website. So in the long term, it might help companies improve and also improve their financials, the business as a whole, their publicity image, by having these surveys done. So as a company, you'd go to Yougov and go, okay, what I want to do is potentially plan what is our brand doing well, what's not doing well. Okay, we want to do potentially a sponsorship with this celebrity or this celebrity. Who is the most popular one to kind of do, or which category, age category are we really popular to, or which are we not popular to? What is our kind of target audience? And you're able to then do these surveys and get all this live data from Yougov, which is supposedly one of the best resources of data. Apparently now, I think it's something like 98% of the surveys are coming in very close to the actual results here, which is obviously, from a Yougov's point of view, is a very good positive to be saying, look, our data is also far ahead of the old survey systems where it's a lot more reliable. And that's where you have some of these big companies, for example, using the likes of Yougov to get their data on how they can improve their business. However, as this video is showing you, obviously the stock has gone through a tough time period recently. The reason why is it came out with a current trading update or a profit warning last week on the 20th of June. They came out and said that they have seen lower sales than anticipated, and they have downgraded their revenue, as you can see here, and they have also downgraded their operating profit from, as you can see here. So they're seeing a lot of weakness at the moment, and I can kind of see that at the moment. You know, you look at quite a few companies that reported in the last quarter, and I think there was a few companies at the moment that were saying they were seeing a lot of weakness. One that pops to mind already is the likes of Salesforce, for example. I know they brought out earnings and they dropped a fair amount, and there's been other companies as well. So maybe there's kind of that bit of a pulling back in the spending at the moment with how the economy is, the slower economy out there. And hopefully we are going to see the carry on in the data usage, because data is so key to companies that, oh, okay, this is maybe a bit of a blip, they've done really well, maybe that we're just seeing a weaker economy out there, and that's the hope that they kind of rebound from this sort of situation here. The only thing that I'm going to say about Yougov from this trading update that we did have is a little bit frustrating, because we had a last trading update on the 26th of March. We actually got the results for the 6 months, the interim results. And even though there was a little bit of weakness in these results, they basically came out and said, like, okay, we've started slow, but we're starting to see the recovery. Now, to say that we're only going to be like, what, 3 months on, and Yougov have now come out and said, actually, yeah, it's actually Now, profit warning, we're downgrading our outlook. It's kind of a little bit like, okay, well, when you last talked to us 3 months ago, you were kind of saying that we are seeing the recovery, but yet now you've downgraded the guidance. Were you a little bit unhonest with actually what was kind of going on here? And they actually did the same thing again, is that they said that we have seen improvement in the second half, but the growth was below expectations. They're kind of saying once again, oh, but we are getting a bit better here. But that was something that maybe is just something to be a little bit cautious about with the likes of Yougov that's currently going on there. But if you do look at the long-term game plan, I mean, the old long-term game plan wants to go from 500 million and 25% operating profit margin. They've actually, 3 months ago, they actually upgraded this to 650 million in revenue. So we'll see if that does happen here. But they've normally been a company that has historically performed very well, and this is why maybe I think it's just maybe a bit of a blip at the moment. You look at the numbers they did between financial year 2014 to 2019, very good numbers. Same from 2019 to 2023, good numbers once again. And if they do get close to these next medium-term targets that they set out every kind of 4 years, if they are able to get anywhere close to these numbers, then I think the share price today actually does look quite attractive. And the focus on still all that data that's needed, and also you look at potentially the acquisition, the growth plans they have in the US, for example, and the growth plans they now have in the Europe, Eastern Europe in particular, with their recent acquisition of GfK. If they are able to get this, very successful in the likes of the US and into Europe, the company should do very well. That's the big risk, is are they going to do it? And that's what ultimately, I guess, is Yougov going to be successful. The only thing that I will say that I don't like from Yougov is that they have kind of wrecked the balance sheet with this acquisition. If you do look here, they did have a cracking balance sheet, and it has gone up to 213 million in debt. Now, the company is very profitable. They do throw off 80% gross margins, I believe it is. The profit margin as well has the potential to really ramp up. So if they do end up ramping up the profit margins, where they do get to the point of view where they're doing 40, 50, 60 million a year in profitability, obviously they'll be able to pay that debt off, very quickly in the next 3 or 4 years. But they've got to get there. That's the big thing. The other thing that I think is worth pointing out is that at the moment, the revenue growth is slowing down from the profit warning. But when you do look at the business, it doesn't really take that much investment to kind of support that revenue now. So any improvement in the revenue growth will lead straight to the bottom line. And that's where we'll see the profit margins expand. When you look at the current operating profit margins that they're targeting, it's very easy for them to get there. They just need to get the revenue up. Now, the big thing is, are they going to get the revenue up? That's the $1 million question. And I think that the need for data for a lot of these companies will see the company go back to very good growth in the long term. But that's the big risk that you have at the moment, is it going to get there? And that's the $1 million question you have with Yougov now. And if you do go buy Yougov in the current situation. So I thought what we'd do is we'd actually have a look at some of the current numbers that Yougov could potentially do. Now, once again, I just go back to the current numbers that they're going to do. And obviously you can see here the decline in profitability at the moment, as we've just covered from the profit warning. It has been updated on Simple Wall Street. However, the analysts haven't really changed the long-term figures. I'm not sure on that one. I think we might see some of the analysts start pulling back these longer-term figures, as you can see here at the moment. But I'll try use their longer-term guidance they're going for with 500 million in revenue. And if we actually go off the updated guidance, which is 650 million on their medium-term revenue and 25% operating profit margins. Now, obviously, what does that translate into the bottom line? We don't exactly know, so I will take that into a little bit of consideration when I do run the numbers. Now, at the moment, I've put 5, 7, 10% revenue growth, which would be a lot slower than what they are forecasting at the moment and what they've historically done. And a profit margin of 5, 6%, which is currently what they're currently doing after the profit warning. That would include no ramp up with the greater revenue coming in, and a 20 times earnings, which they roughly trade at right about now. There's not really much upside in the kind of company here. So you can see here the downside is worst case scenario, and that'd actually be the profit going actually a little bit lower than where it is right now, actually, to be fair. There's not really much upside. So if you think that this is the worst the company is going to get, you're going to be okay. Now, the big thing is if we do see the improvement in the numbers, which if you do go for the medium-term targets and the company does come back to more revenue growth, because all the costs are in place, the profit margins do go back to what they have historically done. They were at them sort of levels back in 2018, 2019. If you look at more of the recent profit margins, they were kind of pushing up towards those 10, 11, 12, and even 13% profit margins. That's where you're going to be a big winner on this one, because your profit margins, for example, let's say the company does get back up to 13% profit margin, I put 14 there, sorry. If they do get up to 13% profit margins, then you talk about where the company has that 100% upside here, which is really nice. And the other thing as well is, like we talked about the guidance. Obviously, the lower end was the 500 million, but like we said, the updated guidance now after the acquisition is actually 650 million. So if we do actually try put in their new updated guidance, if they are able to get there, for example, and by the way, that was the medium term target, so we're expecting that to get to them sort of levels in 2026, 2027. If they were able to get to that sort of growth, which would suggest something like it would even be more than 15% growth, actually, let's go 19%. 19%, you actually start getting a bit closer to where they are forecasting, and you actually have a lot of upside there. I mean, there's 242% upside coming up there. I mean, I don't know if that's still going to happen, but even if we go the 500 million target in 2028, that's still 149% upside. I mean, let's try get to on 2027. Let's say they get to the 500 million target in 2027, for example. So I got 14% puts us on around about 510 million in that time frame. The company comes up with 188% upside, which I think is fair enough. And that's, by the way, that's on a multiple of 20 times earnings. I mean, if you do 13% profit margin on 14% revenue growth, I don't think you trade at 20 times earnings. I think you're going to probably trade at a bit of more of a premium, maybe like 25 times earnings. And yeah, there's definitely a lot of upside there. So yeah, Yougov, at the moment, I look at the stock and go, yeah, it was a disappointing update. I think the company maybe got the numbers a little bit messed up. The balance sheet is maybe a little bit weaker than what I was hoping for, even though we kind of knew it with the acquisition. We knew that that was going to be the situation around the balance sheet. Yeah, a little bit of a disappointing update, but if you think the long-term picture for Yougov is still okay, I'd be willing to hold, and that's what I'm doing. I'm willing to hold, and in fact, I'm looking at the stock going, you know what, I'm actually maybe a bit of a buyer here, because yeah, sure, the numbers were disappointing, but you know what's priced into that share price right now? When you look at that share price drop at the moment, you know what's priced in? That whole profit warning is priced into the stock now. So if the company now does go back to a good numbers where it does start moving in the right direction, a lot of the costs there are already in place for the future growth. And if the growth does come back, and even if it's not the growth that we were expecting, maybe we were expecting maybe 15-20% growth, even if it grows like 10% a year, I still think there's pretty good upside here. And that's with the profit margin recovering. I mean, let's say the profit margin doesn't recover as much. Let's say it still holds around the 11% mark. I'm still thinking that I'm going to do okay from this one. So a little bit of a stinger and a little bit disappointing to see the trading update kind of come out from the stock. But overall, look at the long-term game plan. I think this should be okay. I mean, we'll come back. I think I'll review it in a year's time, and hopefully we start seeing that usage of data for companies start recovering. And I'll have as always, it's easy in hindsight. We'll come back in maybe a year, 18 months to just kind of see if that recovery in that data came here. If not, I'll probably have to sell out of it, and the recovery's not happening. But if it does come back, I don't think it's that bad at the moment. So yeah, even though I'm a bit disappointed with the update, I am disappointed with the update. Obviously, you don't want to take a big drop like that. But what is now priced in my point of view, is an attractive risk to reward. So I definitely didn't sell with the trading update, and if anything, I'll probably maybe just buy a few more shares, and then I'll sit on that. I won't go any more deeper than that in case it does go wrong, but I'll probably just buy some shares at these levels, and then I'll see how it works out. So we'll see what happens with Yougov anyway. So hopefully that's the last big awful update, and trading does improve anyway. So that's my thoughts on Yougov anyway, guys, and I'll see you in a bit.